He paid an accountant $30,000 the previous year to do their end-of-month reconciliations, to do their estimated tax projections, to do their tax return filing. And yet somehow, this egregious error was allowed to occur because it wasn't a tax planning engagement, because the accountant was not there to collaborate with the owner to save him money on tax dollars.
Well, hello and welcome to another episode of the Profit with Law podcast. I'm your host, Moshe Amsel, and today we're going to be doing something a little bit different. So we've been doing guest episodes for a very long time. It's been, when I first launched the podcast in 2019, I started doing a combination solo episodes and guest episodes, and every week we did 2 episodes. That was a bit much. Cut it back to once a week, stuck with the guests, didn't do a lot of solo episodes. And I feel compelled to add in or pepper in some solo episodes. So I was going to record this from scratch and decided that I had a webinar that we did that was really, really good. And rather than recreating this for the podcast, I'm just going to record this introduction. We're going to play the webinar, and then I'm going to record the ending for your consumption. Now, for those listening on a podcast player, this was a webinar done with a slide deck. So if there are times that I'm talking and it sounds like I'm visualizing a visual aid, that is what's happening. This can also be found on YouTube. So my team created a link for you to go to. It's profitwithlaw.com/tax episode. profitwithlaw.com/tax episode. If you're listening to this on a podcast player, you can go there if you want to catch the video version that is posted on YouTube. So that's number one. Number two is there could be benefit in watching those visual aids because I show numbers on a screen. I show how we calculate a formula. But I think that there's a lot of information here that you will still get in the audio format. So I don't think you have to go over there. I think you can still go about listening to this podcast the way you normally do. But if you're listening to it and you're like, wow, that is gold, I need to understand this more, just know that you have that destination to go to. If you're already on YouTube, great. You're here. You're going to see it. And I'm excited to share this episode with you. So what's going to happen is we're going to basically play this webinar where on that webinar, what I do is I lay out a number of strategies that we use with our clients in their tax planning engagement with us. So there's 2 different things that I show in there. One is I highlight a big expensive mistake that I found somebody was making when we were engaging in a sales conversation, and I looked at their tax returns, and that really it was so big because of because of how much it was. That it was eye-popping, but the mistake could be made by any one of you. And I wanted to educate the market and just show you an example of where you might have an accountant, but it doesn't necessarily mean that you're saving every dollar in taxes that you can, because mistakes like this happen. This was a highly successful law firm owner paying his accountant probably $20,000, $30,000 a year, and this mistake was still allowed to happen. So that's one thing. The other thing is I'm going to show you how we helped one of our clients get an absolutely free car by basically saving enough money to pay for that vehicle. So pretty crazy stuff. And I lay it all out in this podcast. I'm excited to share it with you. So without further ado, here we go. Check it out. Actually, last announcement before I pass you off. You can also, if you already know that, hey, whatever he's going to share here, I would like to have a conversation with the Profit with Law team about my taxes. You can book that call already now. You don't have to listen to the whole episode. profitwithlaw.com/tax planning sales session. profitwithlaw.com/tax planning sales session. We'll link all that up in the show notes as we always do. That is the URL for booking a call with somebody on our team. All right, here you go. Our tax planning webinar that we recently did.
All right. Why most business owners overpay in taxes and how to stop. The reason I'm so excited about this is because you guys are going to get blown away. Today, I'm going to share with you how we helped one of our clients get a Lexus SUV absolutely free. I'm also going to share with you how we ran into a law firm owner who paid over $500,000 in taxes unnecessarily. And I'm going to explain to you how that happened. And I think that what's going to happen is that you're going to learn a lot about tax code, tax strategy, stuff like that. I don't want you to feel overwhelmed. The idea is that I want this to be educational. I want you to get a ton of value from it, but I also want to bring home a point, and that point is going to be apparent very shortly as I jump into the slide deck. So, but I want this to be interactive. We're going to ask you questions, ask you to be involved, but let's jump right in. So, you're in the right room. If you understand that knowledge is power, and you want to know as much as you can about tax saving strategies. You're currently paying more than $30,000 annually in taxes. This is not a requirement, but if you are, you're definitely in the right room. You own a business, such as a law firm. Doesn't have to be a law firm. Business owners, this pertains to every business owner practically. You would like to pay as little in taxes as is legally allowed. Okay. This is my beautiful family. Really proud of what this has become. It just kind of like walking through life, and it just is what it is and became what it became. And I love every single one of them. But you've on one side you see my three daughters and then my wife, and on the other side are my son-in-laws, and then the four little kids in the middle are batch two, the four kids I have with my wife now. And those three young ladies that you see and those three young men all became parents in the last year, and I'm now a grandpa times three. So really exciting stuff. And I share this picture with you because I do what I do because of who I am, because I'm a family man, because I want to focus on my family. I want to make them a priority in my life. That's why I do what I do, and that's why I started my business, and it's also why I chose to work with business owners to help them to create freedom in their lives so that they can also put family first. And I think that part of that has to do with being able to get the maximum value from your business, whether it's on the front end of having high profitability or on the back end of paying as little in taxes as possible. So today we're going to talk about the back end. I am a IRS enrolled agent admitted to practice before the IRS. I can represent anybody in tax court. I have a ton of experience. I've been doing that since 2014. And I do a lot of research and read a lot of case law, and I really understand the business, and I understand how to get clients results. I host a Profit with Law podcast as well as the YouTube channel of the same name. Also host the Law Firm Growth Summit. Decided in March of 2019, and we're going all in on the legal vertical, and that's when the podcast was started. And now we're approaching 500 episodes. Really love what we've created there. I'm also a certified Profit First professional, aligned with the book by Mike Michalowicz, who's very, very well known. It is about cash flow and cash flow in your business. So just know I've been around the block. I've been working with law firm owners for a number of years, and we help them in fractional CFO capacity and coaching capacity. And I know what I'm talking about. So I'm gonna bring some really good information to you today. Now, at the end, I'm going to give you an opportunity to work with us. If you already know you want to work with us and you want to beat the rush, you want to get on the calendar, those spots fill up, here's the link for you to book a tax planning sales session. So there's a lot of S's in there. So I had had somebody put the QR code there, but Nicole's here in the room as well. She could drop the URL into chat for you guys to click on. If you already know that you want to work with me, you want to solve the tax problem for yourself, book that call now. But we'll talk about that later. I want to give you a ton of value, and here we're going to go. So The first question that I want to ask you is, do you have a good accountant right now? So most people, when I run into them, they say, I have a good accountant. I've been using this accountant for years, right? How do I know I have a good accountant? Well, I pay a low fee. They return my calls. My family's been using them for years. I haven't been audited. They get me a good refund. Now, these might all be true, but none of these make a good accountant. None of them. And the problem is that what people should be saying, but they do not. And you know what's interesting is that, and I don't want to get political here, but Donald Trump, the first time that he ran for president, he stood up there with Hillary Clinton, and he said, "You know why I'm smart? I'm smart because I pay $0 in taxes." Now, I don't know if that's true or not true, but the reality is that it's true that if you are smart, you will pay as little in taxes as possible, right? So, um, people should be saying that I have a good accountant because they meet with me throughout the year to help me make decisions that save me thousands of dollars in taxes. Every time we speak, I learn something new about tax saving strategies. When I started working with my accountant, they asked me for 3 years of tax returns and identified missed opportunities that turned into easy, found money. My accountant decreased my effective rate. You even know what an effective rate is? The effective tax rate is basically, so there's a tax bracket that you're in, right? So let's say you're in the 24% bracket. You're not paying 24% on every dollar. The first $30,000, you're not paying taxes on at all if you're married filing joint because you get a standard deduction. The next $10,000, you're paying 10%. The next $20,000, you're paying 12%. Then you go and jump up to 22, then 24, right? So your tax bracket is only for the next dollar that you earn. The effective tax rate is if we take your total income and your total taxes and you divide the total taxes by the total income, that's the percentage that you paid on the total amount is your effective tax rate. And you might be surprised to find out what that is. But if you don't know what that is, you should probably look at it and you should probably focus on trying to get it to lower, to get it lower, right? I want to pay less percent of my total income on taxes. You know you need a new accountant relationship if you do not recognize any of these terms. I'm going to throw a whole bunch of terms at you. But a good accountant should be having conversations with their clients and educating them and explaining to them what opportunities they have, what things mean, what they're signing when they sign their tax return. But I'm going to ask you, what I want you to do is there's two screens here. So I'm going to go through one, go through the second. Count on your hand how many of these terms you know, not just saw before, but you know what they mean. And then we're going to go and chat and you're going to tell me how many. Okay. So here we go. ERTC, SETC, reasonable compensation, employer match, QBI, standard deduction, estimated payment, PTET. If you guys need me to tell you what these stand for, I can tell you. TCJA, QSEHRA, which is pronounced QSERA, ICHRA, which is pronounced ICRA, carry forward, NOL, small employer pension plan credit, small employer health insurance credit, home office deduction. Now, what's interesting is that some of you might be looking at this saying, I never heard of it, but this sounds like something I need. Commute first business trip, vehicle over 6,000 GVWR, SSTB, 199A, tax bracket, S Corp election, and more. So, I don't know, how many was that? 12 on the first slide and 9, 11, 10 on the second slide, 22. All right, let's jump in. So, when do you meet with your accountant? Put it in chat. When do you meet with your accountant? Now, some of you said you don't have a good accountant, so I'm guessing you might not ever meet them. When do you meet with your accountant? I'm asking you to put this in chat because I want you guys to be like, this is a conversation. Scott says never. Adelina says never. This is a problem, people. It's a problem. Your accountant should be your best friend. They should be making you tons of money. It's like people are afraid to talk to their accountant because it's like, how much am I going to owe? If I don't talk to you, maybe I won't owe it. All right. We don't have a lot of people participating in chat. I would love it if people got more involved. When do you meet with your accountant? Most people meet with their accountant between February and April to discuss the prior year's tax return. When, shocker, it's too late. It's too late to use 95% of the strategies displayed on the previous slide. We just showed you 22 items. All 22 of them have a way of impacting your taxes in a good way, meaning all of them are ways to lower your tax bill or have something to do with lowering your tax bill, but none of them, not a one that it was on that screen, could be used after the year ends. It's too late to change or fix anything that has been done incorrectly. Too late. Once the year ends, it's over, right? There's some things that you could do till April 15th. You can do your employer match of your simple IRA, SEP IRA, or solo 401k. Your accountant's so busy and rushed in this time period from February to April. And by the way, I'm an accountant and I'm doing a webinar, right? How crazy is that? Your accountant's so busy and rushed that even with the best of intentions is bound to miss any remaining opportunity you may have for tax savings, right? How could they be doing a good job for you when they're trying to cram through 20 of these in a day, right? Which would you rather? An accountant that prepares a tax return that looks proper in a timely manner, or an accountant that finds every opportunity to plan your business around your tax situation, saving you anywhere from $20,000 to $100,000 in taxes every year? I'll ask you to put it in chat, but I'm pretty sure we're all going to agree on which one of these we'd prefer, right? Let's see. Is anybody putting in chat? Both? Yes. Both wasn't an option, right? I wanted you to pick one or the other, right? Which is more important? How many of you have or would implement any of these without a discussion with your accountant? So this is so I'm asking the question another way, right? I asked you how many times you meet with your accountant. Most of you said never, right? Now, some of you will say, "Oh, I've implemented this in my business," right? I want to know, did you have a conversation with your accountant when you did? Purchase a vehicle, decide to buy versus lease, hire staff, decide whether to pay someone as a contractor versus an employee, open a 401k, provide health insurance to your staff, buy or sell your home, make an investment outside of the business. You just saw the 8 things I put on the screen. Let me know if you've ever discussed with your accountant any of these items. And if you discussed all of them, then your name's probably Theta. Angela says none. Adelina says none. Do you know that if you open a 401k, you're eligible for a tax credit in the first 5 years the plan is in place to cover the expenses of the plan and even cover some of your employer match if you do that for your employees? Did you know that providing health insurance to your staff is the worst way to provide health benefits as a small employer, and that you should be using that QSEHRA, right, the QSERA or the ICRA plans to do that? You can give them so much more at costing you so much less, right? Um, did you know that? Let me go back one screen. Did you know that if you lease a vehicle, you cannot accelerate depreciation of that vehicle? And therefore, if you wanted to try to write off $50,000 in one shot by leasing it, you've killed that. You can only do it if you buy. Did you know that it makes a difference if you buy a vehicle, how much the vehicle's official curb weight is? If it's over 6,000 pounds, you can probably expense the entire thing if it's more than 50% used for the business. If it's less than that, there's all kinds of rules about how that can be bonus depreciated, and it's only a fraction of the cost of the vehicle. So you buy a $50,000 vehicle, you might only be able to accelerate depreciation on 20,000 of it. All of these things have a direct impact on the taxes we pay, and yet we are not discussing them with our accountant. How crazy is that? Each of these decisions has significant tax ramifications worth tens of thousands of dollars, yet it never occurs to us to consult with our tax guy. I've got a tax guy before making the decision, right? Why? Why is that? So I think this is on us. I think this is on the accounting industry. I think the only reason I can think of is that the accounting and tax industry as a whole has done a crap job, piss poor job, whatever you want to call it, educating the public on these matters. And for that, I apologize. But what it also is because is the accounting industry in general has focused on simply the act of filing your tax return as being the value that we provide. The reality is that there is a ton of value that we can provide throughout the year that is worth way more than simply filling out a tax return for you. And that is why I wanted to do this webinar today. That is why we're having this conversation, because I want to bring that home. I want you to understand that there is tens, if not hundreds of thousands of dollars of capability that we have in controlling your tax situation by having conversation throughout the year. So what I did was, oh, this is a cool slide. That stops today, right? We're putting an end to it. No, I'm going to educate you, right? I'm going to show you. We're going to do two case studies. I'm going to show you two case studies, real life law firm owners that we worked with in the last 12 months, where proactive tax planning has or would have saved them a significant amount of taxes. Okay, are we ready? We're ready to buckle up. We're going to jump in. Okay, now here's, you got it. You got to stay with me. So if you're distracted by something else, I want you to come back, because if you get lost in this scenario, you might not understand what I'm explaining. I'm going to try to bring it down to third, fourth grade level, not because anybody here is dumb or anything, but I really want you to understand the basics, the things that are driving the results that are created in these cases. Case study one. This is a $561,076 mistake. Let me know in chat if you would have loved to keep $561,076 instead of sending it to the IRS. If this was you, how pissed off would you be if you found out that you made this payment unnecessarily? If and this particular accountant, so I spent 15 minutes with this this law firm owner's tax return, and I identified this problem. 15 minutes. He paid an accountant $30,000 the previous year to do their end of month reconciliations, to do their estimated tax payment, projections, to do their tax return filing. And yet somehow this egregious error was allowed to occur because it wasn't a tax planning engagement, because the accountant was not there to collaborate with the owner to save him money on tax dollars. So what is this big mistake? Now, here's the scenario. Imagine you had an incredible year in your business. The year is about to end. You have a $4 million profit you want to distribute to yourself. Now, many of you are thinking, well, I wish I had a $4 million profit, right? Well, you don't make a 500 something thousand tax error without having made some money. But I will bring it down to levels. If you're doing less than 4 million in profit, or 8 million in profit, or 10 million in profit, if you're doing less than that, I will bring it back down to your level, okay? But I want you to see this is something so basic, yet and so obvious to me as an accountant, but may not be so obvious to you as a business owner. So you reach out to your bookkeeper and you say, hey, got this $4 million of profit. I want to pay myself $4 million. Can you please cut me a bonus payroll? The year's coming to an end. I want to make sure I take that money home. Cut me a bonus payroll for $4 million. Woohoo! Felt good. Cue the confetti. The ball's dropping on New Year's Eve. It's December 31st, going into January 1st. I am happy. Pockets are flush. Now, along comes this guy, Moshe, And he says, let me take a look at your taxes. We're mid-January, beginning of February. Too late to change anything that happened last year. 15 minutes. 15 minutes. I was able to see this amazing mistake. Scanned his taxes. Under 15 minutes, discovered the worst for this law firm owner. Now, do you know what $4 million looks like after you pay taxes on it? What's the net or take home of that paycheck? If you guessed about 1.8 million, you'd be correct. So your top tax bracket is 37%. You hit that when if you're married filing joint, which this particular person was not, but even if you're married filing joint, 670,000 or 710,000, I don't know the number off the top of my head, but around there is where you hit 37%. So the bulk of this 4 million is being taxed at 37%. Then if you live in a high tax state, which this individual did, you're paying 9-10% to the state. Call that 47%. Then on top of that, because it's run through payroll, you're paying FICA taxes. Social Security maxes out after 160 something thousand, but the rest, Medicare, you're paying 1.45% on the employer side, and the employee side 2.9, and then on your personal tax return, you get excess Medicare income for excess wages, 0.9%. So when you take that $4 million check, run it through payroll, rinse it through the tax system, what comes out the other end is not 4 million, it's 1.8. Now, if seeing this makes you sick to the stomach, which it should, right? Without planning and strategy, a very large chunk of the money we worked so hard for goes to the federal and state governments. Now, we all should pay our fair share in taxes, but we also should not pay more than we need to. What if I now told you that you should have taken home $280,000 more? Now, I said the mistake was 500 and whatever, $60,000. This happened over 2 years. So each year the mistake was made similarly, and therefore it was like 280 a year. What if it's too late and it cannot be undone? What if this was done 2 years in a row? Bye bye, $561,076. It was nice having you for the brief moment that you were in my bank account. Now you're in the coffers of the IRS and the state. So let's understand the mistake. Like, what was this mistake? How did this happen? Who wants to know? Who wants to know how this happened? Theta, you were very close. You were correct. 2 million. Right. Theta wants to know. Vanessa wants to know. Who wants to know how? What was the big error? Right. Like, how did this person pay extra in taxes? Can anybody guess? See if you have any knowledgeable people in the room. Take a guess. Take a guess. Take a guess. I'm having a lot of fun here, by the way. Bouncing around. Okay, cool. So nobody's guessing. It's fine. I'm sure you're going to come in and tell me as soon as I explain it. To understand why the simple decision to run the bonus through payroll was such a costly mistake requires understanding a few tax strategy concepts. I told you I'm going to educate you today, and here we go. Strap in. Wages are taxed with FICA. When you pay somebody through payroll, there is FICA taxes. FICA is a combination of Social Security and Medicare. The employer pays half of it, the employee pays half of it. When you're a sole proprietor and not an S corp, you pay the whole thing. It's called self-employment taxes. The Social Security is 6.2% up to $168,600 in earnings. That is the employer side. The employer Medicare side is 1.45% on all earnings. The employee side is exactly the same amount, right? So when the very first dollar you earn, you are immediately getting taxed 15.3% on that dollar up until $168,600 in earned income. And then you stop paying the 6.2%. And because you're a business owner, you're paying both sides of it. So that's 12.4% you stop paying, but you're still paying the Medicare side for every dollar you earn forever and ever in earned income. So that's 1.45% times 2.9%, right? Now, here's another concept. Reasonable compensation. If you have a business and you open an LLC and you elect to have that LLC treated as an S corp, you have to pay yourself on payroll. So I know this person is an S corp because they have payroll. A partnership, the owner does not have payroll. They have something called um, of course, it's escaping me now, but it's on this future slide. Um, and um, Guarantee payments. Thank you. Guarantee payments is what partners have, how they collect income from a partnership. Sole proprietorship doesn't get anything. Like you just draw the money out because you're paying for all of your income as if it was on W-2, as if it was um, earned income. As a S corp owner operator, you are required to pay yourself a reasonable wage through payroll. But what is reasonable? We actually help our clients come up with what is reasonable. And guess what? It's not, what do I think an owner of a business should get paid? It's, okay, how much time do you spend answering the phone? Oh, 20% of your time? You're a receptionist for 20% of your time. How much time do you spend selling? Oh, you're a salesperson for 20% of your time. How much time do you spend marketing? Okay, you're a marketer for 20% of your time. All of a sudden, we start taking these jobs and they're 60,000, 70, 80,000. We can get you as an attorney, as an owner of a business, we can get your reasonable compensation to be anywhere between 60 and 100,000. Most of my clients are never more than 100,000 on reasonable comp. We want this to be as low as possible so that you're not paying those taxes I just laid out. 6.2%, 6.2%, 1.45, 1.45. We don't have to pay that if it's not wages. So as an S corp, we want to only pay reasonable compensation. So wages and employer taxes paid as a business expense that reduces income of the S corp. Okay? Now, here's one more concept. So when you pay yourself on payroll, you get the income personally, and the business takes an expense, and it decreases the profitability of the business. Well, there is something called pass-through entity tax. If you live in a high tax state and you do not know about pass-through entity tax and you're running a profitable business, shame on your accountant. Not shame on you, shame on your accountant, because you have been paying more in taxes unnecessarily since 2017. Well, it took them a couple of years to introduce the pass-through entity tax, to come up with it, and to actually get it through to be legislated and decided upon. But in 2017, President Donald Trump, in his first term, passed this massive tax bill. It's called the Tax Cuts and Jobs Act, and it completely changed the way that we do taxes. It made a flat tax for corporations of 21%, but didn't change the taxes for individuals. I mean, it changed a little bit, but the top individual tax bracket we said was 37%. So if you're running a partnership, an S corp, or a sole proprietorship, and you're paying at the personal level, you could be paying as much as 37%, where somebody who's a corporation is paying 21%. How's that fair? Right? Well, we're going to talk about that in a little while because that's QBI. But what else they did in 2017 in the Tax Cuts and Jobs Act is they reduced what you're able to itemize and itemize deductions for state taxes to $10,000. Now, if you are in a high tax state, you're paying income tax to the state of 8, 10%, even 6% of your income. If you're making $100,000, you almost are at 10 grand right there. And then if you own a home and you have $10,000, $15,000 of property tax, I live in Rockland County, New York. My property tax is $18,000 a year. I hit the 10,000 when I'm in by July with just my property tax. We lose the rest. So what the states came up with is this brilliant concept. And they basically said you as a corporation can choose to pay your income tax to the state on the profit of the business at the business level and then give a credit to the owners, pass a credit to the owners that they could use on their personal income tax return to take a dollar for dollar credit for what was paid at the business level. Now, because it's a business level tax, it reduces profitability, and therefore you do not pay the federal tax on that money. So, say I made $100,000, I pay $10,000 to, I'm in New York, so pay $10,000 to New York State. It reduces my income by $10,000. Now, if I'm in the 22% bracket, I don't have to pay 22% on that $10,000. I just saved $2,200 of taxes by using the pass-through entity tax instead of just paying it on my personal return. Now, I share this with you because all of this is intertwined in this big mistake that this attorney made in paying himself on payroll that $4 million. So this is not an error. This is actually the work that we do with our clients during the year and at year end to help them to mitigate their tax bill. So who wants to get a free car? Now this is the actual picture of the actual car that my client was able to purchase because of the work that we did with him, absolutely free on the backs of the IRS. If we wouldn't have got involved, he would have, instead of having this car, paid the IRS and the state taxes. This is wild. Okay. Oh, Bree wants to know, what should the client have done? So in that example, um, simply take a distribution. When you're an owner of an S corp, it's kind of like paying a dividend, but at S corp level, it's already been taxed because the income is passed through on the K1 regardless. The distribution gets listed on the K1. The only time that distribution will get taxed in addition to the income tax that it's already being taxed on is if you take a distribution in excess of the basis that you have in the business. Meaning, you can't go to the bank, borrow $1 million for your S corp, pay yourself $1 million, and not pay taxes on it. It has to come from net income. If it comes from loans, it's going to decrease your basis below zero, and then you'll get taxed on that for capital gains. But so no, you don't pay yourself on a K1. You just take a distribution. The K1 will have the net income from the business listed in box one, but it'll also have the distributions listed. I think it's box 19, category A, right? Is where distributions go. So yeah, it'll be on the K1, but you just pay yourself, right? In your books, you would mark it as owner distribution or something like that. So how do you get a free car? Tell me how to get a free car. Okay, so here's the scenario. Law firm owner has a great year. Firm just hit 1.5 million in revenue, and the owner has a salary of $100,000 with business profits of $500,000. Her spouse earns $120,000 at her job. Whoops, getting the hers and his is mixed up here. Without tax planning, this firm, the firm owner, will pay $244,702 in income taxes to the IRS and their state. Okay, let me just go back. They made 1.5 million revenue, 100,000 salary, 500,000 in profit, so $600,000 total, and the tax bill is 244,000. Not crazy, but it's a lot of money, right? Like, you're paying in taxes more than most people. Like 95% of the population is earning as their entire living for the year. That's not the point of this. And I'm going to show you the math, so I don't want you to get worried about that, right? I'm just setting up the case, right? With tax planning, we were able to have the owner purchase a Lexus TX 500H hybrid, which I have no idea what that is other than I have the picture of it and I saw the bill of sale, right? For $86,476. And through a few steps that we took, lowered the tax by $107,077, making the Lexus purchase absolutely free with an extra $30,000 of spending money to boot. Woohoo! All right, so let's understand how this happened. There's a few pieces of the puzzle that we need to understand. We already talked about pass-through entity tax. Well, here it is again. Okay, pass-through entity tax is one piece of it. Home office expense. Many business owners, they're aware of the home office expense. Many are not. Many business owners falsely think that when you become an S corp, you can no longer take the home office expense because there's no longer a form on the tax form called a home office deduction form, right? A regular 1040 has that to go with the Schedule C. A regular 1120S, the S corp form, doesn't. So you think you can't take it. That's not true. You can. Now, the home office expense is actually really, really important for another reason, which we're going to show you shortly. But What the home office expense allows you to do is it allows you to take an expense you already have, which is your home. You're already paying the mortgage, you're already paying the taxes, you're already paying the insurance, you're already paying for the utilities, you're already paying for the internet, you're already paying for all these things by simply making a room a home office or even making a spot in a room a home office. You can take a percentage of all of those expenses and make it a business expense. Not only that, but there's another thing, and this is going to be really key when it comes to the car. Um, I'll explain it now. We'll cover it on a slide in just a bit. But when you go from your house to your law firm or your business, if you don't have a home office, that trip is called a commute. It is a personal expense, not a business expense. When you have a home office and you drive from your house to your office, you are making a trip from one office to the next. Inter-office trips are a business expense. In order to accelerate depreciation on a vehicle at an accelerated rate, you need to have more than 50% of the business of the vehicle use be business use. It is very difficult to get to 50% if every day you're commuting to work and it's a commute. But if every day you're driving to work and that's the bulk of the mileage you're putting on, and that is a business trip, it becomes very easy to have more than 50% use of your business vehicle. So it's really important to have the home office in tandem with the ability to buy a car for the business. Home rental. So this strategy allows the owner, and by the way, you can rent your home to anybody up to 14 days without claiming the income. The income is tax-free. Once it's more than 14 days, you have to put it on a Schedule E and you have to claim it, and then you take your home as an expense against it. You can do the same for your S Corp. So you can rent your house to your S Corp for 14 up to 14 days. And you can charge fair market value for that day, and we can get that fair market value up depending on where you live, but for many homes we can get it up to around $2,000. So imagine just having a meeting a month in your home, a full day meeting with your leadership team once a month in your home, and then a holiday party and a kick off the summer party in your home. 14 days. Boom. 14 days of rental. You can bill that to the business, collect it as rent. The business takes it as a rent expense, but you don't have to pay taxes on the rent income, and therefore you're decreasing your expenses by just moving money from one pocket to the other. Increasing your expenses, decreasing your income. Now, another thing that we did is prepaying expenses. So the IRS allows you to prepay an expense for up to 12 months in advance. So you're already paying rent on your office. You're not breaking the lease. So if you need to decrease your income, we can just prepay some of that rent. In this strategy, we went and prepaid, I think it was 7 months of rent to get to where we needed to go. The owner was going to pay it anyway. They're going to not pay it now in the next 7 months and essentially recoup that outlay of cash. So it's not an increase in cost in order to get this free car, right? The vehicle purchase alone, to be able to fully deduct a vehicle purchase using tax code section 179, the vehicle needs to be used more than 50%, and it also needs to have a gross vehicle weight rating. So it's not that you weigh it. Like people think, oh, I could just add a piece of metal to the back of this car and it's going to be heavy enough. No, it needs to be a manufacturer rating of that car. It has to be over 6,000 pounds. Now, the home office is also needed. I explained that. It's here on the slide in order to make this work. But we can fully deduct the purchase price of the car in the first year that we put it in service if it's over 6,000 GVWR and we're using it more than 50% in the business. The last piece of the puzzle is QBI and SSTB. So remember earlier I told you about the Tax Cuts and Jobs Act, and I told you it was unfair that flat tax for corporations was 21% and we're paying 37% at the top. They introduced this concept of QBI. QBI stands for Qualified Business Income, and what it means is that if you have a pass-through entity, a partnership, a S corp, or a sole proprietorship, Schedule C business, on your personal income tax, you can take the first 20% of your profit and deduct it from your income before you calculate your income. And when you do the math, that allows you to even the playing field and not be paying 37% on that income. The problem is, in their genius of wanting to avoid abuse of the system, they came up with this idea that doctors, lawyers, and accountants, and architects, and other designated professional services personnel are going to find a way to open an S corp, and instead of getting paid W-2 wages from their employer, they will bill their employer as an S corp and have their own business. And then if they all do that, then it's going to be abusive, and it's going to be a way of passing money to them that they can just get away at this lower tax amount, and it should have been higher because it should have been W-2 wages. So what they did was they created a cliff. A tax cliff is basically where at a certain point, when you hit that point, you lose the thing. It's usually used in tax credits. Like once you hit 180,000, you can no longer take an education tax credit, right? Um, so the cliff for SSTBs, specified service trades or businesses, for a married filing joint person is $483,900. When you earn more than $483,900, meaning if you have 483,901, you lose the entire QBI, which means if 300,000 was business income and you earned one more dollar, you're now paying taxes on 20% of that you weren't paying a minute ago. Right? It seems unfair. It is unfair. It makes no sense. It should not have been part of the code. It is, and we have to work around that. Okay? Now, our objective was to get the income for this particular taxpayer, this particular scenario, to be below the cliff and therefore save the QBI deduction. Okay? So here's what we did. I'll show you the math. Who's ready for me to dive in? You guys still with me? Yes, Scott, you can get a free car every year. The problem is that when you sell the car, because you fully depreciated it, whatever you sell it for, and trading it in is a sale, is now a gain, right? So you're going to pay taxes on the gain. The good news is that the car is going to significantly depreciate, and therefore you will not have a huge gain. So there'll still be a net benefit. And Theta wants to know about the car being owned by the business. In a lot of these things, like the home office, the car, it does not need to be owned by the business. You can actually submit an expense report to the business and get reimbursed for it. So you can purchase the car personally and then have the business reimburse you for that purchase. Okay, cool. So this is the current scenario. Okay, before we get involved, owner takes $100,000 in salary, $500,000 in business income, $600,000 total. Spouse has a $120,000 job. Together, they are making $720,000. Now, a married couple filing jointly gets a standard deduction of $29,200. I didn't want to get lost in the weeds of itemized deductions. Let's just assume they're taking the standard deduction. They don't get QBI because they are earning too much. They're over the 400. So I have it in here, right? The 483,900. They're over that amount. And therefore they don't get the QBI. And their taxable income is 720 minus the standard deduction, 690, 800. Their federal tax on this amount is 182,530. Their state tax, if their state tax is 9%, you can plug in whatever number you want. This particular client was in a high tax state, and this was their state tax, and their total is 244,702. That's the number I shared on the slide when I first set up the scenario. $244,702 is how much tax they would have paid. We're ignoring estimated tax payments. We're ignoring child tax credits, all that kind of stuff, which, by the way, you earn too much here, you wouldn't get the child tax credit. I want to keep this simple. This is the basics, right? This is the reality. Now, here's our job. We have to take their current taxable income after the standard deduction of 690, 800 and get it below 483,900. So if I take 698,800 minus 483,900, I get $206,900. We have to find $206,900 of expenses to decrease the income of this business to be able to get the QBI back. So here's what we did. Pass-through entity tax. Now the pass-through entity tax we did off of this net number. So in other words, 690 minus 206,900, not 690, the 500,000. So what we did was, I'll just show you the math. We did 500,000 minus 206,900, the net result of the work we're doing, times 0.09, which is how much the pass-through entity tax is how we figured this. Okay, so 26,379 can get paid to the state. It has to be paid in the current year. This is all of this stuff has to happen in the tax year, which is why it's so important to have this conversation not in February, but in November or October or even earlier, right? The home office expense, not a big one here, but it's $5,561 and every dollar counts. The rent of the home to the business for 14 days, we have it at $1,975 for this client, which came out to $27,650. The vehicle purchase we already know was $86,476. Now, prepaying rent was the last piece of the puzzle. We did 7 months of their rent. The rent was $8,700 a month, and that was $60,900. Now, I put a note here, right? Here, we're shifting the tax from one entity to the other. We're shifting it from the person to the business. This tax was getting paid anyway, right? So we're not paying any more than we would have paid. Here, we're reallocating personal expenses to business expenses. We already were paying that. We're just shifting where we're booking it, right? Where it's getting recorded. The vehicle is a new expense. We're actually shelling out $86,476. But we would have shelled that money out in taxes had we not bought the car, right? And then this is timing. So we're going to pay the rent now, and then for the next 7 months, we don't have to pay rent, and we're essentially going to get that money back, okay? Now, this is going to hurt next year's math, right? Because we moved it from this year to the year before. Now, what's really cool is that if you own your office building and you are the landlord, and say you're losing money every year on your rental property because when you first put it into service, that happens, you can actually pay more. You can shift expense from the business to your rental property to offset that negative amount, and you're not increasing your income, but you are decreasing your income on the business side, and you can get there too. So some really cool stuff you can do with this. Now, so we got to 206,966. Our goal is 206,900. We're $66 in. It's all we need. So now this is what it looks like. Salary of 100,000 to the firm owner. The net profit of the business is 293,034. Okay, so it's 500 minus 206,966. Their total income 393,034. Spouse 120. Total income for the two of them is 513,034 minus the standard deduction. Gets us below the QBI cliff, and now we have less QBI, which is 20% of 293,034, $58,607. Our total taxable income is now 425,227. Federal tax on that is 91,446. State tax on that. Now there's two pieces here. There's the state tax on this income, right? And then there's the PTE tax that you already paid, right? So we're actually, this state tax is being calculated on everything but the business income because that's already been taxed, okay? And then this is the pass-through entity tax, which was paid on the business side, but we're counting it because it was taxes paid, right? So our total taxes paid is $137,625. Well, let's see what this looks like. Let's make it a little lighter so you can really see it. Our savings, 244,702 minus 137,625, $107,077 in tax savings. And we were able to take that savings and buy a car with it and still have 30 plus thousand left over. How cool is this stuff? This is pretty neat. All right. So what's the takeaway, right? What's the purpose of showing you these examples, right? Look, I want you to understand the power of tax planning. I want you to understand what happens when you have productive conversations that are looking at your situation, looking at where you're headed, and looking at your total picture of your family and your other assets and your other businesses and what everything else going on in your life to see what we can do to lower your tax bill for you. What what is going to help you? Like maybe you don't need a car. Maybe you don't care for a car. But what if we can do something else? One of the things we did with one of our clients, they had extra income. They didn't need it all, right? We helped them invest in mass torts where when you invest in a mass tort consortium, only attorneys can do this. If you're not an attorney, you can't, this is not an option for you, but this is a crazy tax strategy. You invest in a mass tort consortium where you're getting together with other attorneys to create a marketing pool of dollars to get people who are in a class for a mass tort where you're going to end up getting a percentage of the payout, and it's a marketing expense. You're investing in the marketing side of the mass tort business. So when you invest that $100,000, normally when you put money in an investment, you got to wait until you sell it to have anything that affects your tax situation. But here, it's a marketing expense. So you can take a $100,000 expense today. And in our situation, it meant that we immediately decreased the risk of that investment to $60,000 because you saved $40,000 in taxes. So it only cost you out of pocket 60 grand, right? Now that thing is supposed to pay off like that. There's no guarantees, but usually over the course of 3 or 4 years, they pay 5 or 6 times your investment. Who doesn't want to put $60,000 in and make $600,000 in 3 or 4 years? That's twice as fast as you can double money in the stock market. As attorneys, you have that option. You would never know that if you weren't on this webinar. You would, I mean, some people may, right? There might be 1 or 2 people in this room who might know about that. So notice that all of the strategies to create these situations involve taking steps during the tax year and not after, right? We have to do this stuff while it's happening. Also notice that someone needs to have a vested interest in achieving the tax savings goal to be willing to spend the time to design the strategy, right? Accountants who are just doing tax prep, they're too busy doing volume. They're not even interested in spending the time with you. Finally, knowledge of the state of your business and profit levels has a lot to do with which strategies make sense to implement. So you got to have good bookkeeping. Your books have to be up to date because if we don't have good numbers, we can make all the plans in the world, but we're going to miss our target, right? We've got to understand where your business is at. This is why you want a professional in your corner, right? Starting to make a lot of sense. So, the one question that you might have is if there's anybody in this room who's early in their business or they're struggling in their business and you're not making a profit, right? And you're like, I don't pay taxes. I don't make a profit. I don't pay taxes. Why is this relevant to me? Why would I want to spend money on somebody to create a tax plan for me when I don't pay taxes anyway, right? Is there anybody who relates to this question? Like all this makes sense, but understand. Um, I didn't understand how this would help me. Anybody have this question? Scott did not have this question. You're making money. That's good. Okay, I'm going to answer this question anyway. Maybe somebody on the replay, nobody's saying yes, but there is still a reason why you want to engage a tax professional. I'm going to introduce you to another two strategies or 2 things that you need to understand. Many of the strategies we can implement are still worth doing because of 3 concepts. Okay, offsetting income, carryovers, and net operating loss. Let me explain each one to you. Offsetting income. So if you have other income, say you're building your law practice over here, you're married to a doctor over here, your doctor's bringing home $300,000 in income. You just started your law firm In the first year, you're taking Moshe's advice, you're putting some capital to work, you're investing in marketing, you're investing in people, you're actually not making money. As a matter of fact, in the first 12 months of my 18-month, $1.5 million business plan, we project that you're going to lose $350,000. So it's your first year of business, and now you lose $350,000. Guess what? Your $350,000 loss gets to offset your spouse's $300,000 of income, and that $150,000 that they withheld in taxes on their wages, you get as a refund because of the loss in your business. So if you can increase the loss in your business and offset more income, you're paying less taxes. Therefore, a lot of the strategies we do, which are increasing your loss, even if it's just on paper, are worthwhile doing because it could offset other income. To the same note, there's also something called carryovers. So let's just take the office deduction as an example, right? You're not allowed to take the office deduction beyond zero. So if I have a $25,000 home office deduction, but I have $0 in income, I can't go to negative 25. I have to carry that 25,000 to the next year. The beauty is that as I carry this from year to year, when I finally make money, that earnings is going to be tax free because I built up this stuff that I carried from year to year. So if I run at negative 25 for 3 years in a row, but I'm never able to take it, I now have a $75,000 asset where I can earn $75,000 and use up the $75,000 I carried, and I make no money on the tax paper, and therefore I pay no income taxes on those dollars, right? So that's a carryover. And then the last one is NOLs, or net operating loss. The tax code allows, if you have a net operating loss, to go back 2 years or move forward 20. So if I have a net operating loss and I had income in the year before, I could actually carry the loss backwards and get a refund on taxes paid for the previous year or the year before that. To the same vein, I can also carry it like I'm carrying the carryover. The net operating loss can be carried forward for up to 20 years. So it behooves us, even though we're not paying taxes, to still pay attention, because with making a few adjustments, we could potentially be carrying $30,000 or $40,000 more in losses per year than we would otherwise. So in a year that you make 200,000, that could be the difference between paying taxes on that of 100 or 80 or whatever, and not versus not paying it because you carried it over from these years by doing smart things along the way. So it's relevant even to somebody who's not making money. What is the value of this type of relationship, right? To have a tax planning relationship with the accountant, what's the value of that? How much would you be willing to spend to have this type of relationship with your tax advisor? I mean, I just painted scenarios. I showed you a $500,000 scenario, which even at lower levels is $30,000. I showed you how a $500,000 business of profit could be, and by the way, 1.5 million in revenue could be 500,000 in profit. You could be there in 12 months if you're not there yet, right? How much would you be willing to spend to get this kind of advice? Would it be worth $10,000 to create $100,000 in tax savings? My guess is it would be. Now, the reality is I'm not going to charge you $10,000 to have that kind of relationship with you, but I'm pretty sure each of you would be willing to spend that kind of money if that was the result, right? How much would our first case study, think about this, how much would our first case study be willing to pay to have his $500,000 back? What would he be willing to pay if somebody could go back in time and get it back for him? What fee would have been worth it? I would argue at least 10%, right? He would have been willing to pay $25,000 a year to be saving that money. You'd probably agree, right? So when we think about this, sometimes we look at something, we're like, oh, that's expensive. But no, it's an investment in what you're going to create with it, right?
All right, wasn't that incredible? Absolutely golden content. I love it. Actually, the feedback I got from my team was that was way too long for a webinar, so we're actually going to cut out that first part. But let me just let you know that what next steps, right? If you're interested in exploring what it might look like to work with our team and be engaged in a tax planning engagement throughout the year. Meet with us quarterly and be able to save a ton of money on taxes because you're paying attention throughout the year. You're not waiting till year end, till it's too late to have a conversation with somebody who may or may not be good. You want to go through all this stuff and do all the strategies and save all the money. Even if you're not profitable right now and your tax bill is zero, it's important to understand that you can carry net operating losses forward. It can offset future income. So there is definitely value in having this conversation, even if you're not making money. But if you're making money, then the ROI is significant. So if you want to have a conversation with us, that URL to book a call with our team is profitwithlaw.com/tax planning sales session, profitwithlaw.com/tax planning sales session. And we'll link that up in the show notes. And if you would like to watch the video version on YouTube of this episode, go to profitwithlaw.com/tax episode, profitwithlaw.com/tax episode. Folks, we're here every single Thursday with a brand new episode. Most of them are interviews with amazing experts. We love the conversations we have here. I have an absolute blast here behind the microphone, having these conversations on your behalf, and I appreciate you being here as a listener. If you are not subscribed to the show and you want to be, hit that subscribe button in your podcast player so you get notified every time we go live with a new episode. Every time we release a new episode, you'll get notified. It'll show up in your feed. You want to be subscribed to us on our YouTube channel. There's stuff that's going to be coming on YouTube. We do shorts, we do reels, we do all kinds of stuff to give you really great content in all kinds of forms and formats. At some point, I may be doing live broadcasts, which it will then notify you if we're doing a live broadcast. Really good stuff. So would love for you to hit the subscribe button. So you stay tuned. You're in the know with Profit with Law, and we'll see you next week. Take care.